Hello, this is Ronnie, and I'm going to take the lesson session for Finance for Administrative Manager, which is level 4 business, diploma in business. And today's session is on budget. So today's session on budget, and then I'm covering Finance for Administrative Manager, the learning outcome 2, which is understand how budgets and budgetary techniques can be used to plan and control finance. So as we know, we are very familiar with the word of the budget, and we are going to discuss about what a budget is and what kind of different control and mechanism and strategy based on the business objective, understanding budget preparation, and then the value of monitoring actual results and against the budget, and then how to prepare the simple, flexible, and flexed budget in one kind of manufacturing business. And so we, on the basis of to understand how budgets and budgetary techniques can be used to plan and control finance, and then objectives today. I have defined then a budget and show how the budget corporate objectives based on long-term and short-term plans are related, and the explanation of these interlinking different kind of budgets variances within the business. So this budget actually is a very common term. We use the budget in our day-to-day life and everyday life. So budget is a short-term business plan mainly expressed in financial or monetary terms, and that plan covers any kind of income, inflow, expenditure, or expenses, and any kind of buying asset or capital investment. So that's basically budget is a plan for future forecasting. Any business establish their mission and the objectives to determine why they are in business. Definitely there is a set of objectives and goals and what kind of objectives they want to achieve. So that's basically a long-term issue or mission or vision. But these objectives are then developed into more specific and quantifiable goals, which is doable. And then when we segment these kind of quantifiable goals, and that's usually 6 months to 1 year, that's a short-term plan, and that means of working towards a business objectives in the longer run. So there is a steps and in planning process in budget. So definitely there is identification of the business objectives. What objectives the business owner or the management are following for definite budget planning. So that's set the objective. And then we need to consider the option, different kinds of options. If it is a sales budget, we have to consider the capacity of the sales costing, and then other variable and mixed or semi-variable and fixed cost. And then on the basis of this consideration, there is definitely an evaluation to select the definite process of the budget, which budget option the management or the business can go. And then on the basis of the consideration and evaluation, then the long-term and short-term projects can make. So these are the basic process of the planning of the budget: identification, consideration, evaluation, and preparation. And now, for the consideration of the issues, basically for the budgeting, definitely goal and how to achieving that goal. That's the main consideration. To achieve the goal and to plan direct to achieve that goal, the business needs the methods how to achieve that goal. If it is a production budget, if it is a sales budget, if it is a manufacturing budget, definitely there is a method how to avail that goal. And then there is definitely the resources requirements, whether the human resources, financial resources, and other resources, and what kind of applications, management, marketing, finance, and other application means are supported to that achieving goal. Human resources definitely are involved, and definitely should be a profit planning which should be accepted, or that's acceptable range of profit planning, and then overall the monitoring and controlling of this consideration of to achieve the specific goal. That's the issues for consideration to plan a good budget. So let's take one example how to control the budget to achieve the set of objectives. Say for example, there is an island and we need to achieve that island. There is a treasury in that island and we need to go. There's a after the ocean, we need to travel the ocean, and then there is a treasury island. We need to take that treasures to achieve that destination. So let's start to our journey. So for example, we have a ship and we want to go from here to that destination. So that's our plan. Now, so when we start our journey to have that treasures, the valuable stones, so we have obstacles in the middle of the journey. So say, for example, we have sea pirates. So we need to stop here and then we need to redirect our route to other way. So we redirect our route. So from here to redirect our route, so we change our direction to go there. So that's the redirection. And then in the middle of the journey, we have a storm, an unavoidable situation, natural disaster or calamities. So there is a strong wind and storms. So again, we change our direction from here to other way. And then we found a very, very hazardous sea shark underneath the ocean. So we have to change again our direction from here to here. So let's see, this is our original destination, original planning, and then we have to change our destination in different way because of these kind of obstacles and the situation. So here we changed 3 or 4 times our destination to achieve that goal. So this is the basic understanding of budget and budgetary control. Sorry. So from the original route, if there is an obstacles or unavoidable situation, we need to change our direction and our objective to achieve that goal. So if you take an example of any one film, so let's say example the Gladiator, the famous film. So objectives of this film to obtain a surrender or destroy, that's like, you know, the theme of the film. So we have to plan and another planning for alternative the plan to obtain objective. If there is an unavoidable situation coming, and if there are any unplanned events, so how we tackle that event in the middle of the journey or any kind of budgetary plan. And we need to consider the resources. That's the plans of the budget. Resources is one of the important factors. Without the resources, you can't have achieved the objectives or goals, or you can't set the strategy. So definitely there is a different department, different wings, different resources. Management needs to be considered. There is a monitoring how the battle is going over the period to achieve a stipulated time period to achieve that goal. And then always there is an environmental factor. So for example, if it is the raw materials and if it is like grown in the grown on the soil, so definitely there is a production and there is a harvesting, the different factor, and there is supplying factor. So all these types of options business can consider when they make a budget and then when they execute the budget effectively. So this is the one example of the making a film, how they make a plan and then execute to achieve the final outcome of the film. And definitely there is a costing, and then there is a costing of the less equipment and over equipment. So for all these plan and budget and the control is focusing on the profit for the business, because we need a profit, and then that profit give us to cover all the costing and the other things to the business, because the business object is always a profit maximization and the wealth maximization. So definitely a business need a profit to satisfy its stakeholders or shareholders, and then definitely the profit needs to meet the stock market, to raise the finance if they want to buy any assets or capital investment. So they need to consider the return on capital employed. That's the return on capital employed. How they use the return on capital employed, they need to show the profit at the maximized stage. And then if the business want to do any fund expansion, they need a profit. And then definitely if there is a market obstacle or there's a high rate of inflation in the market, they need to have a more profit in the business. So what's the different types of budgetary process if it is a manufacturing company? There's a different types of budgets in a manufacturing company. So for example, sales budget. So these are broken down by product group, because this is based on a sales. So this is a different type product broken down by product group and the geographical area, and then decisions are taken on new products or whether they drop old products. So sales budget as basically depends on the product budget. If it is a production budget, to achieve the stock levels, definitely the stock in the store or in the production, and then the business needs to work out the required monthly production or the fortnightly, weekly production. So stock levels is related with the production budget, sales budget is related with the product group, and definitely the location or the geographic area. So there is also the materials, labor, and plant capacity, and the other budgets, the overhead budget, the materials, direct labor, other budgets. These elements of productions all need their own budgets once production requirements are set. So when the production budgets and the requirements are set, then the business needs the material, labor, overheads, the other budgets. Cash budget is one of the very important budget in the company or business, because that is associated with the cash inflow and the outflow. So how many cash is coming to the business inflow by the sales, and then expenditures, cash outflow, and the payments. These financially ties in all the other budgets together to show the total cash requirements for the particular period. For this, and they can make a future projection of the basis of the cash budget. There is also a summary budget. This breaks down that the budget across the time periods, divisions, subsidiaries, the summary of the different departmental budgets. Master budget, this is one of finally adopted when the senior management have adjusted the budget according to what they need to satisfy the investors and other interest parties in the company. So all these budgets are responsible to financial reporting or any kind of, managerial reporting. So the budget is then dispatched to the relevant senior staff whose job is to control that budget. So this kind of different kind of budgets and budgetary process for the manufacturing company can consider and segment to plan and forecast. Now, as we can understand what budget is and how can we prepare a budget plan preparation, considering the different options, evaluation, and on the basis of the evaluation, they can go for the short-term and long-term budget. Now, this is a projected budget. So when budget is executed, that's the actual budget. So, for example, the electricity budget is £23,500, and over the last year that executed in the meter, the bill has come 27,200. That's it over the actual budget. That's over £3,700 over. So this is called the difference between actual budget and the original budget, called the variance. Now, when the variance is acceptable and when the variance is favorable, or when the variance is adverse. If there is any cost item, any kind of expenditure and cost which has exceeded the budget, that is always adverse and negative. And which is any kind of cost which exceeds the original budget, that is always affects adversely, negatively to the profit. But any kind of sales and income budget, for example, if it is sales, profit, any kind of receivables, that if it is exceed to the original budget, that is always a favorable. So income budget is vice versa to the cost budget, and then there is a like terminology. If it is A, that's adverse, right side of the figure. Or if it is a negative, that's adverse. So within the bracket, it is a negative figure, and then normally in the practice, we always write A, that's adverse, and F, it is favorable. So all cost budget, if it is exceed to the original budget, that's actual budget. If it is higher than the original budget, if it is a cost budget, that is always adverse. So for the planning and for the monitoring, we always try to reduce the actual budget in terms of cost budget. For the sales budget or the income budget, we always try to increase the actual budget. So for the income or any kind of sales, we need to increase the actual budget from the original budget, and if it is increased, then it is favorable. And if for the cost budget, if it is decreased, if it is actual budget is less than the original budget, for the cost budget, then it is favorable. Okay, let's take one example to understand the variance and in terms of adverse and favorable. Say for example, here is examples of sales. So the original budgeted figure is 21,000, and our actual budget is 25,600. So this is the sales, and this is the materials, labors, overhead, variable, fixed overhead. So these are the cost budget: direct materials, direct labor, variable overhead, fixed overhead. The cost budget, if the cost budget, actual budget is less than the original budget, that is favorable. But sales and profit budget is our income budget. So if the sales budget is actual, this is original. If the sales budget is higher than the original budget, then it is favorable. And the cost budget is, if the actual budget is less than the original budget, then it is favorable. So let's see the example of the figure. So 21,000 original budget and the actual budget is 25,600. So the variance is the difference between actual and original budget. That's 46,000 because it's favorable. It's favorable because the actual budget is higher than the original budget. And we can see that all these budgeted figures are less than the actual budget, only the variable overhead. So direct materials, the actual budget is higher than the original budget, so that's adverse because it's a cost budget. That's higher, and because it is a direct labor, it is a cost budget, that's adverse. But you see the variable overhead is less than the actual is lesser than the original budget, and the actual budget is less than the original budget, that's a favorable. So if any kind of or cost budget is less than the original budget, that's a favorable. And any kind of cost budget is higher than the original budget, that's the adverse, unfavorable. So as we can see, our actual sales and the profit budget is higher than our budgeting figure, so that's a favorable. If it is higher, so that's a favorable. So that's the basic understanding of the variances. The cost budget in the actual term should be reduced, and profit and sales income budget in the actual terms from the budget figure should be increased. That's the favorable condition of the business. So now let's take a different types of budgetary explanation. So here in this session we are covering fixed budget and the flexible budget. The fixed budget means the budget is prepared on the basis of an estimated volume of production and estimated volume of sales. But no plans are made on the event that actual volumes of production and sales may differ from budgeted volumes. So that's the fixed budget. So if you have a sales and cost figure, if you have an income and the cost, the expenditure figure is 45,000 and 38,000, and then in terms of actual situation, that the figure is different. So let's see the variance, whether it's adverse or favorable. So on our original budget, our budgeted figure was 45,000 sales and 38,000 cost, and then profit is 7,000. So that's the original budgeted figure, original. In our actual, we have the sales 43,500 and the cost, which is reduced from 38,000, which is 35,800. But our profit is increased 7,700. Now the variance 1,500 because sales is decreased from the original budget, that's adverse. Cost is decreased from the original budget, that's favorable because it's a cost budget. If it is decreased, that's a favorable. And if it is profit is increased from the original budget, £700, that's favorable. So cost and profits budgets are favorable in terms of execution, and the sales is unfavorable or adverse. So we conclude that although the sales have fallen, sales decreased, the costs have fallen by more, producing a favorable effect on profit. So if the sales decrease, the cost decreased, but its effects on the profit. So that's a favorable condition. Now, what is the relation between the budgeted and the actual profit? So how can we calculate the budgeted profit? So if we take the budgeted profit plus all the favorable variance, which is favorable, and then we can deduct all the adverse variance, then we get the actual profit. The budgeted profit plus favorable variance all, and all adverse variances that should be deduct from this figure, and then we can get the actual profit. So now we have seen here, so we have a budget, actual and variance, and that's a fixed budget figure. Now we go for the control system, how we control this budget when we on execution on our actual budget. So we have to see our objective, whether it is long or short term, and then what kind of objectives we are achieving, like buying capital asset, or we are going for the cost production budget, or kind of sales budget. And then on the basis of that objectives, we make a plan, and we know how to make a plan for budget. And that's the very beginning of this lecture. We have showed, I have showed you one diagram of the planning a budget, and then we go for the action. And the action I showed you from one ship which is going to the destination of the Treasury Island, and then if the ship got a different unfavorable situation in the middle of the way, they change the route to achieve that goal, and then they measure how to achieve that goal, and then they compare. Last thing is compare and correct. So always compare with the objectives and the actual budget, and then remeasure, and then correct, and then this is actually the cycle, the vicious cycle: compare, correct, and remeasure on the budget with the actual and original budget, and this is the control system of the budgeting procedure. Benefits of the control, any kind of budget, they always motivate to the staff, because if it's uncontrollable, and then that will be a disaster for the business. So if the controlling systems always motivation cycle of the staff, they always do the coordination and communication, and then there is always a delegation of the authority. The different departments are involving to plan and execute the budget and the actual budget and the variance analysis. So these are the types of benefits of a budgetary control, which is very helpful to decision making, and that's the key involvement of the staff and motivating to the staff. Now, there is always a criticize for the budgetary control system, and then criticism of budgetary control systems, definitely the cost. And if the cost is very vague and with the basis of any kind of proper evidence or the practical experience, that would be a disaster. There is a term, the flexible and fixed, and sometimes it's flexed. So if it is inflexible, that's the problem. So budget is not always inflexible. It's because the business has got a definite objective, they have a definite cost, and then budgeted plan, and they have a limitation of the budget. So if it is inflexible, that would be a problem. And then there is a limit of initiative to plan and change the budget. There's always a crisis. And there is a defense mechanism. There is no defensive mechanism of budget if there is an adverse situation. Some budget plan failed in the middle of the way, and they couldn't achieve their final destination. And then there is a criticism, create need to spend, because the expenditure is always a very crucial aspect of any kind of business. So these are one kind of criticism, and then recriminations is one. Another one is criticism of a budgetary control system. And there is always there is no definite performance appraisal system of budget and evaluation of the performance of the budgeting assessment. They're absent, and then these are always a criticize of the budgetary control. So to make an effective budgetary plan and monitor and the budgetary control, the key is the make to success is training and practice. To overcome this kind of criticize in a budgetary control system is training and practice, and more involvement with the practical aspects. So monitoring procedure, another aspect is flexing the budget. So I'm taking one example here for the monitoring procedure. It's a flexing the budget. It's called flexible budget. A flexible budget basically recognize the existence of fixed budget, variable budget, and the mixed budget. So as we know, the fixed budget is very much fixed, and then variable, there is a kind of, tolerance, and the mixed budget is semi-fixed or semi-variable cost. So fixed budget, flexible budget recognize the different kind of existence of fixed cost, variable cost, and mixed cost. Mixed cost consists of semi-fixed cost and semi-variable cost. And it is designed, the flex budget, to change so as to relate to the actual volumes of production and sales in a period. To flex flexibility, either multiply original budget by the actual units, and it has to be divided by the budgeted units, or calculate the percentage increase of actual units over the budgeted units and add that percentage to the proportion, or work out that variable cost or unit from the budget and apply to the next to the flexed budget volume. So basically, flexible budget, when the volume of output or sales is different from the budgeted figure, and the budget is often flexed to reflect the actual volume or activity. And this flexible budget give a more valid comparison between the flexed and the actual results, because the variable cost will automatically increase if the volume of activity increase, and the variable cost will automatically decrease if the volume of activity decrease, and it's vice versa. So if the cost increase, the activity always increase, and if the variable cost decrease, the other kind of activities decrease. So why compare a budget for cost of production based on 23,000 units when the actual units produced are 27,000? See, there is a variance. So cost of difference, there is a difference of 400 units. So let's see the example. So 1,400 units is the original budget, and the flex budget is 1,600 units, and the actual is 1,600 units. Now, here there is a difference of the flex budget of the cost. The cost budget is different in the flexible budget, and the cost budget is different in the actual budget as well. Also, flexible budget is different in terms of sales and in terms of profit. So flexible budget, the figure in terms of sales and the cost and the profit is different from the actual budget. So this is actual budget, this is a flexible budget, and this is the original budget. Okay, now let's take the figure of the original and flexible budget in terms of variance. As we know, the variance is difference between the difference between the actual budget and the original budget. So here the variance is the actual and the flex budget is 16,000 because it's sales, so this is favorable because it's increase of 1,600 units. And again, all the actual budgets in terms of direct materials, direct labor, and the fixed overhead has been increased. That's the adverse. And only the variable overhead decreased. That's the favorable. The difference between these two figures. So in the cost budget, I said before that if the actual budget is less than the flex budget, that's the favorable. And if it's higher than the flex budget, original or flex budget, that's the adverse. And we can see the profit between the actual budget and the flex budget is favorable, which is 182. Now, we need to calculate the flex budget for the following costs. The budgeted unit 80,000 and budgeted variable cost 25,000, and it's our actual units is 16,200. So what is our flexed budget? And then here budgeted units 100,000, semi-variable cost 4,000 pounds. So we have a variable cost here, so we are missing the fixed costs are associated in this figure, so we need to calculate the fixed budget and then we will calculate our flex budget. And here we need to calculate our budgeted actual units, budgeted units, our actual variable cost. Okay, let's see how we are going to calculate. So our flex budget in terms, that's the 25,000 our budgeted variables, multiply our actual units, which is our 16,200, and divided by budgeted units 18,000, that's our 22,500. So budgeted variable cost here is 25,000, and budgeted variable cost in flexed budget is 22,000. So that's the favorable because it's less. So if it is cost less with the budgeted plan, that's always a favorable. Here, in this situation, we know our cost, the variable cost plus fixed cost, our total cost. So here we calculate our total cost, which is 25,000. So our flex budget is 4,300, and these are the calculation, which is higher than 4,000. So that's the adverse. So this is the favorable because this is the less, and that's the adverse. This is 4,000 and that's 4,300. That's adverse. So here we can calculate the flex budget in terms of this information and this formula. So again, we need to calculate the variance of this flex budget. So as we can see, we have a sales, and then the unit per cost is £1, variable cost is 20,000, and 15,000 is fixed cost. In our actual budget, that's the budgeted figure. In our actual budget, we have a 44,000 sales, which is favorable, but the unit cost is 95 pence. And the variable cost is favorable, 21, no, it's adverse, £1,000. It's higher than this variable cost, and this is also adverse, it's higher than budgeted figure, £500 higher. So let's see the difference between the actual and the budgeted figure in terms of variance. So we have a original budget, we have a flexible budget, we have an actual budget, and the variance. Okay, now original budget was 40,000 units, sales, and the profit. Now flexible budget from this example, 44,000 in terms of units, and then we have a sales, and we have these are the sales in terms of units, and then this the profit. Now let's see the actual. So in terms of actual, sales is 41,800, 21,000 pound in terms of variable costs, and these are the other costs. So what are the variance? So variance is adverse in terms of sales because it's decreased from the original budget and from the flexible budget. Compared to the flexible budget and actual budget is 22,000, which is adverse. Variable cost decrease, that's a favorable, and the fixed costs increase, that's adverse, and the profit decreased from flexible budget to actual budget, that's adverse. So from flexible budget and actual budget, we can compare the adverse and the favorable situation in the business. So the units have increased and sales have increased by a smaller proportion due to the price discounting. The variables have increased, but by a lesser proportion, and the fixed costs have increased, producing an adverse effect on profit. So the manager should consider whether they flex this budget again, because the actual situation is here. So for the forecasting in the next year or the short-term period, they need to reconsider the figure in the flexible budget and the original budget. So how budget helps managers? That's the question. So we have seen the different kinds of examples of flexible, fixed, and the variance analysis from the original budget and the actual budget. And then we've seen that if the cost budget in the actual term is, if it is decreased, that is a favorable situation. And if it is cost budget in the actual situation is increased from the original budget, that's the adverse situation. And in terms of income, profit or sales, if it is increased in the actual budget situation, that is favorable condition, and if it is decreased from the original budget to the actual budget, that's the unfavorable or adverse situation. So that kind of situation planning help managers definitely to promote forward or future thinking and the possible identification of short-term problems in terms of cost and expenditure and income. And that plan can provide a system of authorization for the managers to spend up to a particular limit. If it is flexed budget, if it is a fixed budget, that amount, that's the situation can help to manager to set the limit of the budget. Obviously, that actual and the variance analysis can motivate all the managers of different departments to better performance, to get the good performance, to achieve the highest level of maximization of the business objective. Also, this is a coordinating mechanism. If the different managers need to coordinate, and then can help to different department sections of the business by coordinating each other, and then this budget can provide a basis for the control mechanism. There is also something that limits the business activities. So the limitations of the budget is normally, we mention here, ability to sell these products, but it can be some capacity shortage. For example, shortage of skilled labor or machinery can't give you from the budgeted figure. So like in a skill measurement or any kind of subjective measurement, that cannot be had from the budgeted figure. And it is normal to budget for the limiting factor first, as this will normally constrain the other activities and influence their budget. So if there is a kind of just subjective matter which can't be quantifiable or can't be measured, that is limiting factor in the budgeted figure. So we have seen there is actual budget projection, projected budget, and the variance analysis, but we have seen an adverse and favorable situation now. The manager can set the tolerance level of any kind of outcome. Say, for example, there is a budget and there is actual budget, and then the variance is 15%. So now a manager can set the tolerance. Okay, I can set tolerance level 10% plus minus. If it is decreased, for example, say decrease 10%, I can tolerate that up to 10%. If I increase 10%, then I can set the tolerance. If it is increased 11%, then we have to take an action or take them like kind of consideration and then revisit the budget again. So the manager can set the tolerance on every level of budget. So tolerance is a preset fixation level that may be created in absolute terms of percentage. The tolerance is always set in the percentage. Normally, it's if it is a like reporting figure, so there is a spreadsheet and there is a column, the tolerance, and then they can set the tolerance level in the spreadsheet, and that should be a definite in percentage. And tolerance, the purpose is to create exception reports that dictate management action, as otherwise managers can find it hard to determine which variances need action. For example, gas bill, for example, electricity bill, or for example, transportation costs. So manager can set the tolerance level. In terms of gas bill in this slide, so we have 100,000 budget of the gas bill, but in actual, it exceeds £150. So in the actual situation, so variance is £150. So budgeted figure is thousands, and then actual is 1150. The variance is 150, and then in terms of percentage, it is 15%. And then manager can set the tolerance level at plus minus 12%. So 15% is beyond the 12%, that is adverse. So variance percentage is a variance divided by budget, which is compared with the tolerance allowed, and if it is outside here, so 15% is also not within the 12%, so this is more than 12%, then management can take the required action. So tolerance is one kind of money controlling mechanism to check the actual and budgeted figure, and the tolerance percentage is based on the variance, and then there's a very specific percentage of label, and that should be under the tolerance level, like 10% or 12% over from the variance, and then 10% on 12% less from the variance. So this is one kind of a budgetary control mechanism. So there is another budget, zero-based budgeting, which is adjusted budgeting. Traditionally, many budgets prepared by looking at what has happened this year. So that's the actual budget, and then adjusting this number of budgets for any perceived changes or inflation. So that will be adjusted and kind of change in inflation and any considerable situation. And the zero-based budgeting rests on the philosophy that all kind of spending should be justified. The kind of inflation that's economic environment, then that should be adjusted. The assumption is that there will no spending, and the budget will only be made if a specific case is made for the expenditure. So that's very specific terms, and then the manager know what kind of situation can be occurred in terms of production, in terms of sales, and in terms of direct materials and other overheads protection. So as we can understand, so there is a fixed budget and flexible budget, and there is a zero-based budget. We have done the variance analysis. We have done some controlling mechanism. So there is a control, how to control the cost and budget. So this is a different one. We haven't gone through this one, though we don't follow this one. So this is the terminology in the budget. So we can go for the flexed, zero, variance analysis. These four are important, and you can project this kind of budgeting in your assignments. So now the preparation, as you can understand, what the different types of budgets and then variance analysis and actual and budgeted and the adverse and favorable situation. The preparation, definitely a key function of the budget, and is to coordinate the activities. And in larger companies, big companies, there may be a budget coordination committee and the department and the budget manual. So every year there is a budget reporting and the manual, and then all the managers can follow that to prepare the forecasting budget. The budget manual will state who is responsible. Definitely there is a budget manager, coordinator, departmental manager for preparing functional budgets and the timetable for the completion. So coordinator, definitely having a very key important role in the business. And then at the appropriate time, it is normal for a budget coordinator will distribute forms for the completion by those preparing the budget together and with information about the key assumption of the different departments. So as the example, the coordinator, if it is coordinating in the cost budget, so he has or she has to coordinate the different overheads and production, direct materials, direct labors department, and then there is a set of complete forms that needs to complete, and then he can make an assumption to forecast the future budget. Normally the budget coordinator is a senior member of the staff and then or the accounting team, accounting department. So budget coordinator is a very key role in any business, and he has to be very skilled to prepare and the forecast to make any assumption in the budget manual. There's different types of budget styles, so they can do, the coordinator can do the top down or bottom up. So for example, there's a hierarchy of the company, and then the information can start from top down, from the manager or head of the department to the floor supervisor, or the low down, or the bottom up. From the production level, they can make a proposal, and that will go to the up to the company. So bottom up budgets allow staff to participate in setting their own budget, definitely, and then they are to be said to improve motivation and the quality of the plans. The disadvantage with the participative budgets, that's the bottom up, is that they can take a long time to agree. There's a negotiation, there's always a bargaining, and there's a, battling between the business objective and the practical situation in the staff experience and the practice. So to make it budgetary control, the systems must be taken seriously, definitely. The variance analysis is very important and then should be acted upon. There must be clear areas of responsibility, and all the coordinators must be aware of their breakdown of the cost. And the budget should be challenging but achievable and doable. Always budget is challenging because you never know, as we can see one example of the Treasure Islands, because sheep is going to that Treasure Island, but there is a couple of unavoidable situations in the middle of the way. That's challenging, but finally they achieved to reach that destination. Data is one of the important factors. The data collection and preparation, and then analysis and evaluation, and make the proper report must be regular and timely basis, and must be reliable. If there is a manipulation in data and analysis, that should be not feasible. Budget plan cannot be made. The reporting period should be short, definitely a month, and some company and department, they make it fortnightly and weekly. So the short reporting periods is effective to make a good budgeting control. Reports should be relevant to the manager receiving them, should be relevant with the relevant cost department. And then if it is based on the actual and the flexible and flex budget, that should be relevant to the relevant managerial department. Control action must be taken as necessary. As we have seen one example in a tolerance level. So if we set a tolerance level as 12%, and if it's the results coming on beyond the 12% or the less the 12%, so a control action must be taken as soon as possible and as whenever it's necessary. because the tolerance level is one of the very effective budgeting controlling mechanism to check the necessary steps as possible when its needs control action must be in the budgeting control. So there is a behavioral aspects, definitely, in the business, and then when we make a budget and when we plan and project the budget for the short term and the long term. So unrealistic targets definitely tend to have an adverse effect on the manager performance. So targets and the projected plan should be realistic and doable and achievable in terms of the resources and then timely plan. If managers participate in setting budgets, they are more motivated to achieve them. That will be a more achievable. That's the focus. So focus is the one very important aspect to make and plan to execute the budget. Challenging targets appear to get the best results. So, for example, if it's a very straightforward budget, and if there's critical path analysis, if there is in any adverse situation come to them in the middle of the execution, then what kind of challenging targets they can appear to get the best results of the business and the objectives and the strategy of the goal. So plan, budget, and budgeting control is a strategic decision for every business. So there is also who argue that the adverse behavioral aspects of budgeting negotiate and negate its value as a control tool. That's the one reference here. And then, however, it is true to say that the vast majority of the companies and or the organizations still use the budgeting to help manage their businesses. The beyond budgeting movement suggests organization goals should be based on the external benchmarks, because normally the budgeting plan and control is in very internal controls and then decision. But the beyond budgeting, there is an argument that should be an external benchmark, a range of performance indicators, and the continuous planning then and when plans. So in this session, we have so far gone through the different kinds of budgets. How can we make a variance analysis? What is the variance? What are the different kinds of budget, flexible, fixed, and then how the manager can coordinate with the other department and how to make effective budget and planning, and then what are different steps of plan and budget. And so as you can see, if you have learning to the objectives of this session, I covered the learning outcomes too. And then as you can see, the assignment brief, that you have to cover a budget and techniques and other things in your assignments. That's how budgets and budgetary techniques can be used to plan budget and control finance. So there are the two activities in your assignments, and then you need to explain very comprehensively, and you can take some of this example from these slides on your assignment, on your task 2, on the basis of budgets and other budgetary techniques, and then you can explain the different kinds of variance and how these variance and tolerances are giving any effect or consideration to make any budget plan and other things. So that's all today's session. That's the budget and budgetary control. And then you need to read all of your slides. If you go through all the slides, and if you do some workout on the examples to understand the basic concepts of the analysis, then you can understand everything. And if you have any query or questions regarding budgeting or any kind of assignment briefs on task 1, 2, 3, so you can email me, and I'm in the office 10 to 4 o'clock in the Versity, so you can call me. And I emailed you, so what's the understanding of your first two sessions. I'm expecting your email and the feedback of your understanding. So if you go through the old slides and do some homeworks for me, and then if you have any query regarding this session or assignment briefing, please feel free to email me. So that's all about today's session. Thank you very much.